On the topic of slowdown in the market, we have definitely seen a slowdown in the market, and the main reason for that has been the fact that the supply of new real estate that involves a pre-commitment from whether that be office tenants or residential users has been much lower than you would normally expect through a period of uncertainty such as COVID. So less transactions happening in the market. Interestingly, I would describe the current position as Qualitas, QRI in particular, actually having a very strong pipeline, which is a little bit counterintuitive. But the main reason for it is, if you look at the behaviour of banks who showed a period of retracting over the previous 3 months, been very focused on their existing asset portfolio. If you look at the foreign lenders, many of those lenders have been more focused on their home domestic markets than necessarily focusing on Australia. What it has meant is that the transaction flow has come to more to the alternative lenders than had previously been the case. So we've actually experienced quite a strong uptake in our transaction flow at the moment. The credit quality is holding up. We, as I've previously discussed, we review the portfolio every 4 weeks, and so we've continued to do that through the period of COVID. I mean, interestingly, if I look at the valuations, particularly since March, valuers went out there and started writing assets down, and I'm generalising now, but anywhere from 5% to 15% as I said, a generalisation. But if you further break that down, a valuer really has two main inputs into looking at property valuations. One of those is the discount rate, and the second one is what are they projecting is the future income levels that will be derived from the property. And what you're finding is that when you're in the middle of a crisis, a valuer doesn't really have an exact crystal ball on exactly what those projected cash flows are. So discount rates tended to stay the same, but the valuers were clearly writing down income levels on assets such as office, retail, hotels, and as a result of lower levels of future income, that did impact the property valuations. I think that now, as we're starting to get comparable comps coming through of actual sales, what you're finding is that there's a floor to the discount rate, and I think going forward, what we're going to find is there's probably a tug of war between the discount rate, which is going to be relatively low for quite a long time because of the low interest rate environment we're in, and on the other side of that equation is cash flows and incomes that are less certain, and so there's probably a tug of war between the two, and means that property values. It's my view, but property values will probably go sideways for a period of time.